Hi, I'm Dr. Shameen. I work as Professor of Finance with MF Business School, Chennai. Today, let's see about capital budgeting. Now, what is capital budgeting? Every time a firm is trying to buy a long-term asset, which can otherwise be called as a fixed asset, we can take it that it is making a capital budgeting decision. Now, the other terms that could be used in place of capital budgeting are investment management or project management. Now, to start with, let me define what is meant by capital budgeting. Capital budgeting refers to a firm's decision to invest its current funds in long-term assets in anticipation of a series of returns in future. So I hope from this definition you are able to understand the company is trying to invest its current funds in a fixed asset, and in return it is hoping to get a series of returns spread over a long period of time in future. So this goes without saying that every capital budgeting decision has two aspects. One, a cash outflow on account of which we could expect a cash inflow. So one is the cash outflow and the other is the cash inflow. Now, if you talk to any practicing manager, they will tell you that capital budgeting decisions are very difficult decisions to make. Now let me tell you, why is it that they feel so? They feel so because when you compare the money that goes into a fixed assets, it is relatively very huge as compared to the money that you invest in a current asset. To give you a very simple example, suppose I have bought raw material from a person, from my supplier, from my present vendor, and I am not happy. I have every right to return the raw material. But if I buy a fixed asset, whether I like it or not, I have to continue to use the asset. I cannot return it. I have to continue to use the asset as long as it serves a useful purpose. So in short, I am trying to impress upon you that the amount of money that goes into a fixed asset is very huge, and the amount of money that goes into a current asset is less, and hence this decision that we take with respect to buying a current asset is a decision which we can reverse. But when it comes to a fixed asset, that decision can never be reversed because maybe the company will not be able to afford the luxury of putting it aside and buying a new machine or a new fixed asset to replace it. Secondly, if you see, when I talk about capital budgeting decisions, we have seen that on one hand there is an outflow, and we make that outflow in anticipation of a series of returns in future. Today I am making the outflow, but the inflows are going to come in only in future, and we all know the future is full of risk and uncertainty. At this point, let us also understand what is the main difference between the term uncertainty and risk. When we talk about risk, the probability of the outcome is known. But when we talk about uncertainty, the probability of the outcome is not known. Tossing a coin or tossing a dice is an example of knowing the probability. It is a situation in which we can know what will be the probability of getting a head or what will be the probability of getting a sixer. But when we talk about natural calamities, we do not know when it will happen, why it will happen, and how it will happen. So all natural calamities, you have to understand, are examples of uncertain situations because the probability of the same can never be anticipated or estimated. Right, let's move on. Next important aspect is, when I'm talking about capital budgeting, as I told you, today I make the investment, tomorrow I'm expecting the return. So I have to find a way by which I can bring the inflows, the outflows that are happening today with, or equate the outflows that are happening today with the inflows that are going to be coming in tomorrow. And for that, I need to use this concept which is called cost of capital. And I'm sure you'd all heard about this. Cost of capital is the most complicated, confusing and controversial concept as far as finance is concerned. But nevertheless, when it comes to capital budgeting decisions, what companies usually do is they call up the banker, find out the rate at which he is presently lending and use that as the cost of capital. Now this cost of capital can also be called as the discount factor. So with the help of this discount factor, to make an evaluation between the outflow and the inflows, we will be using that to find out what will be the present value of the future stream of cash inflows which are expected to flow in from that investment over a period of time. So all these complications go to make capital budgeting decisions really very difficult and complicated. Now let's move on to the methods of capital budgeting, the techniques of capital budgeting. Broadly, the methods or the techniques of capital budgeting can be divided into two categories. We have the traditional methods and we have the discounted cash flow techniques. The traditional methods include the payback period and the ARR method, and on the other hand, the discounted cash flow techniques will include the NPV method, the IRR method and the PI method. So to give you a little insight into these different methods, let's start with the first method that comes under the traditional method, which is called the payback period. Now what is this payback period? It just tells you, this payback period just tells you what is the time taken for you to get back or recoup whatever you have invested in the project or proposal. For example, if you have spent 5 lakhs in buying an asset and you anticipate the useful life of the asset is going to be 10 years and every year you can expect a return of 1,25,000, then the payback period for this particular project is going to be 4 years. How did I get that 4 years? The cash outflow 5 lakhs divided by the annual cash inflow, which is 1.25 lakhs, gives you a payback period of 4 years. Now, one important thing that we have to understand about the payback period is when we are talking about the cash inflows, we will be using the concept of net cash flows or net cash inflows. What is the meaning of this term, net cash inflows? See, what we have to do is we have to first deduct depreciation, then we have to deduct taxes, then we have to add back depreciation. Why do we add back depreciation? We add back depreciation because depreciation is a non-cash expense as far as the business is concerned. So when I say net cash inflows, I'm actually referring to cash inflows after tax and before depreciation. So I deduct depreciation, I deduct taxes, that gives me my cash inflow after tax, and to that I add back the depreciation that I initially deducted, and that gives me the required figure, namely cash inflow after tax and before depreciation. Now all these methods that I've spoken about, except the ARR method, you will find only make use of this concept of net cash inflows, because they all believe depreciation being a non-cash expense should be added back when you're trying to calculate what you can expect to be the cash inflow generated or flowing in or coming in from the investment that you have made with your current funds. Now to give you a little insight about the ARR. ARR method is to be called as, or to be taken as, average rate of return method. And this average rate of return method tells you what will be the average rate of return that you can expect on a project or proposal. Now to calculate the average ARR or the average rate of return, this is a simple formula that we use. We take the cash outflow and we divide that by the, we take the cash inflow after tax and we divide that by the initial investment divided by 2. So we take it to be the average investment. In short, it will be cash inflow after tax. I told you this is the only method that does not use the concept of net cash inflows. So it will be cash inflow after tax divided by average investment. Now what is the logic in taking average investment? Why don't we take the original investment? Now authors have argued saying, when I make an investment, it is not as though the entire amount is going to get locked up or blocked up in that investment throughout the lifetime of that asset. Little by little, I will start getting back or recouping whatever I've invested in a project or proposal, and hence taking that as the basis we do not make use of the concept. People prefer to use the concept of average investment rather than going in for original investment. Hence, the formula will be, as I told you, cash inflow after tax divided by average investment. Now, what will be the accept or reject criterion? Assuming I am having under consideration more than one project, how do I decide whether it is going to be this project or that project? As far as the payback period is concerned, naturally it goes without saying, I have to prefer the project which gives me the shortest payback period. And as far as the ARR is concerned, because I'm talking about return on investment, the average rate of return on investment, I have to prefer the project which gives me the highest ARR. I hope that is clear. Now let's move on to the discounted cash flow techniques. Now talking about the discounted cash flow techniques, we have to understand one thing. These are techniques or methods that give importance to the concept of time value of money. What is the meaning of this concept of time value of money? It means rupee 1 received today is not equal to rupee 1 that is going to come in tomorrow. Hence, before they make a comparison between the cash outflow happening today and the cash inflows that are going to come in tomorrow, with the help of an appropriate discount rate, which is otherwise, as I told you, called the cost of capital, they will be calculating what will be the present value of cash inflows that are expected to flow in over a series of years. Then they will compare the cash outflow with the present value of the cash inflows that are expected to come in, and then they will decide whether this project has to be accepted or rejected. Now, as far as the first method is concerned, that comes under the discounted cash flow techniques, let me give you a small insight on the NPV method. NPV stands for net present value, and there are 3 simple steps that are required to calculate this NPV. First, with the help of an appropriate discount rate, we try to find out what is the present value of the future stream of cash inflows expected to be generated or flow in from the investment that we are making today. Next, we will calculate what is the total value of this present value of the future expected cash inflows. From that, we take away the cash outflow, and that gives us the NPV, net present value. And so long as NPV is equal to or greater than 0, we accept the project, and where NPV is less than 0, we reject the project. Of course, when NPV is equal to 0, it goes without saying that we will be reaching the break-even point where we make neither a profit nor a loss. Next, let's move on to the most complicated method, which happens to be the IRR. IRR stands for internal rate of return. This method also gives importance to the concept of time value of money. And maybe I will not be able to cover what are the steps that are required to calculate the IRR, but nevertheless, I can make a distinction between NPV and IRR. NPV, as I told you, conveniently will assume the cost of capital to be known. I told you companies will call up the banker, find out what is the